All right, good evening, everybody. Steve here again. How are we? Great to have you on board. Hope everybody's done their homework. Let's be fair, right? So last week we did a quick webinar and we talked about what your existing portfolio might look like. And that included us giving you a nice little spreadsheet, which means that you could fill in all of the details of your entire portfolio into that spreadsheet. So hopefully everybody's gone along and done that. So obviously normal disclaimer thing here. This is not individual financial advice. This is very generic and classroom advice. See a financial advisor, accountant, if you want individual advice to yourself, obviously. Excellent. So hopefully all of you have filled in that portfolio spreadsheet, and hopefully you followed along how it worked and figured it out. And hopefully it wasn't, I suppose, too confronting, because it can be. There's no space in there for, fudging it realistically. That is what your portfolio looks like. And then at the very, very far right-hand side at the bottom, there's a column there which says weekly cash flow positive. Hopefully that's a positive number and not a negative number. If there's a negative number, then you are paying for some of your properties. And if it's a positive number, your properties are paying you. And obviously we want that to be a positive number, and if at all possible, as positive as humanly possible. And the reason for that is we want to buy more properties. We want to make a bigger property portfolio. We want to make good buying decisions and buy properties that are massively cash flow positive. And the reason for that is because it helps us borrow more money and buy more properties. But also it means that at some point that portfolio will exceed the income of your daily working job. And at that point, you're financially free and you can retire for whatever that means to you. And we had some really robust discussions on Facebook this week about exactly what retirement looks like and what wealth looks like, which I found really, really interesting. So I'm going to go back to a little bit of some basics here on getting finance in New Zealand at the moment, and a little bit about how I see them being a bit different at the moment as well. I'm just going to spend about 5 minutes on that. And then I'm going to give you this evening's homework and another spreadsheet that's going to help you massively understand your ability to borrow money as well. Hope everybody's great. And if not, chuck a question in. I see there's a lot of people chatting in the comments and the side there. That's awesome as well. So if I proof property in New Zealand, well, first of all, you need to save a deposit. Now, the bad news is you need to save a deposit. Bad news is it has to probably be 20%. The good news is you probably only have to save one of these ever. Because if you do it properly, you should be able to save a 20% deposit, buy a property, add value to that property, and then re-borrow against that property again to do the second one and every property after that. By the time you get to 5 or 6 properties, we would hope that you would be spread across 2 or 3 banks, and you could then go to one bank and borrow the money to buy the property from the next bank as well. Larger the deposit, the better, obviously. Had a lot of discussion online in the last few weeks, me doing cash flow numbers on properties and cash flow property deals, and a lot of people going, oh, why are you figuring out on 100% debt when you're only going to borrow 80%? Well, yeah, you're going to borrow 80% from the bank, but the other 20% is going to come from somewhere else, right? It's going to come from my pocket. And I want a return on that as well. It's like saying, if I don't get a mortgage at all, don't I get 100% return? Well, yes, but you still want a return on the money that you actually would have or could have borrowed. And obviously, with a 20% or more deposit, you're avoiding fees and higher rates of interest that some banks can charge as well, which is great. Fantastic. You also want to improve your credit score. Now, I had a quick look at this the other day, and there's 3 agencies in New Zealand that run New Zealand credit scores, and a couple of them are free, and you can basically just do New Zealand credit score in Google and search one of the 3 agencies and get put in your details, and it will come up with your credit score. It'll be anything between probably 400 if you have a terrible credit history to, high 900s. The maximum is 1,000. Nobody's got 1,000, trust me. It's very, very hard to get. Really, you want to be in the high 8s and 9s if at all possible. And that means paying all of your bills on time and being a good credit customer to agencies. But you can look that up. It's not sacred information, and it is pretty much totally free to get your hands on that as well. I just found that really interesting as well. You also want to be able to show stable income. Now, obviously, sometimes you can control this, and sometimes you can't. But what we're preferably looking for is reliable full-time employment, because when you first start buying investment properties, banks want to see that you have at least the ability, if not the willingness, to pay the money back on a regular basis. And now they're also looking at sort of, COVID-proof income streams and all that type of thing as well. And also then if you are self-employed, they want to see stable numbers of self-employed financials for at least 2 years. So bear that in mind as well if you're looking at getting into property investment and wanting to buy some rental properties, but you also want to start a self-employed business. It might be an idea to just do one of those two things at a time, because doing the both at the same time could be quite counterproductive. Just a thought as well. Reduce existing debt. Now, this makes a lot of sense. Banks are slowly bringing in debt to income ratios, and I don't really believe that they've really impacted the New Zealand market too much just yet. Well, what is impacting the New Zealand market is the way that banks look at consumer debt. So consumer debt could be, say you've got a $40,000 credit card limit. You might want to reduce that down to $10,000, because the banks will look at it very, very differently. They might look at it as $40,000 could be taken out of your account at any moment to pay a credit card debt, whereas if you reduce it down to 10, and it's just a safety mechanism for you, you might not ever use it. So we like to pay off our credit cards, pay off high interest loans and debts, that type of thing. And this tends to massively increase our borrowing capacity. And that'll come into when we talk to brokers, which will be very shortly as well. But just knowing that any consumer debt in the background is probably worth paying down first as part of saving your deposit. I know it's really tough to do all of these things at once. It can be very, very worthwhile to do that. And then prepare all your financial documents. Bank's going to want to see an absolute ton of pay slips and bank statements and ID and statements of financial position. I think that I'm a fairly complicated one. I've got quite a few properties these days, but banks want to see everything I've borrowed from every bank, which I know sounds ridiculous, but they want sometimes 6 months bank statements for every mortgage that I have with every bank. So the last, I think, mortgage application I put into a bank was something well over 1,200 pages of documentation. And so I try to do as much of that digitally as I possibly can via email, because there's no way I want to print all those bank statements off. And quite often brokers have some really good systems in place for helping you get that sorted out as well. Some of the bank apps are very, very useful for that stuff. Obviously, pay slips, they also want to see what your standard take-home pay is, and they're not quite as interested in bonuses and overtime and stuff like that, which can be turned on and off to a degree. And then obviously, if you're going to use KiwiSaver or a gift from your parents or something like that, they want to be able to document and prove that as well. And you want this information quickly and very, very early. When I was growing my portfolio very early on, I recognized that I was going to probably be buying houses 2 or 3 times a year. And so I made sure that I had all of this documentation plus a statement of financial position current 3 times a year. So I took Christmas off, but 3 times a year, I would have absolutely up-to-date details in case the lending that I was going to do was going to create a thing called a credit issue, which means the bank wants to see everything. And the crazy thing is, I don't think when you give the bank everything that they even look at most of it, but they want to have it, and you look bad if you're not offering it, and so therefore you have to. Next thing you want to do is understand your options with a mortgage. So obviously a lot of people are refixing mortgages at the moment. What does that mean? Well, fixing float. So floating means that there's an average rate. It's not usually a terribly great rate. And it means that your mortgage is sitting there and it's not really doing anything. It's just paying itself off principal and interest on an okay rate. And then usually you can fix a rate for a lower interest rate if you choose a longer period of time that you're going to be locked in with that bank. So I just looking at some interest rates at the moment, actually, and some of the floating rates are at sort of 6% or a high 5%, and some of the fixed rates you can get at the moment are 4.89%. So they're tempting us to try and fix as well. And then you want to probably look at offset and redraw facilities so that not 100% of your debt or your money is tied up in the mortgage, and that you can actually grab some back out of it if you need to for emergency expenses as well. And obviously, we highly recommend that you talk to an advisor, and we use the Mortgage Supply Company nationwide. Message me or bang a comment in, and we can put a link to Mortgage Supply Company for anybody who wants to have a chat to them as well. And so the next thing you want to really do after that is get a pre-approval. So you want to take all of this mountain of information, your ability to save, your deposit, your clean credit history, all this type of information, and you want to take it to a mortgage broker. And the reason for that is that a mortgage broker deals with all of the banks, and they're going to know the bank that are going to say yes to you. So you don't want them to take you to a bank and show, or you don't want to take you to a bank and show them some incorrect information, or go to a bank where the bank aren't necessarily going to say yes to you. You want a good, strong, happy yes. So we want to take you to the right bank at the right time. Obviously, mortgage brokers deal with all of the banks all of the time, and so they usually have the very best guess as to which bank's going to be happier to offer you a loan approval. So we always really do like to go with mortgage brokers. They have stronger negotiating power, obviously, as brokers, because they're putting a lot of stuff to the banks. They can sometimes ask for things that are a bit, a little bit to the side there. Great. Rome's just put in the link in the comments there for the Mortgage Supply Company if anybody needs access to them as well. Hit it up down there. And obviously having a pre-approval, it speeds up your process as well. It also means you know exactly how much money you've got to spend, so you can actually have the ability to swagger into the property market and make a cash unconditional offer once you've decided what property really suits your portfolio next. Yeah, so as we say, use a mortgage broker, access to multiple lenders, help with paperwork, and they'll help you sort out a really better deal. Additionally, what we find at the moment is that banks are offering cash incentives, and mostly the brokers know how much those cash incentives are likely to be. So, great to have them on board to be able to help you out with it as well. It's a few thousand extra dollars for your closing costs normally on any given transaction that you purchase. Then the last thing, obviously, is to pick a finance-friendly property. Now, we're going to work on that more next week, but basically, you've got to buy something that they can insure. There's a lot of interest at the moment about a couple of a property in Wellington here, actually, which is going for a $1 reserve at auction, but you can't finance it. It leaks, and it's you can't do it. So you need to buy something that the bank's going to actually be happy to finance, but also you need to buy something that's massively cash flow positive so that it helps you buy the next property after that. And I think that's one of the really most important points that we miss out. We get one-track mind. We're going, I've got a property portfolio, I want to add something to the property portfolio. And I've got my portfolio is good, and this property I want to add is good. So putting them together must be good, right? Well, it doesn't necessarily always work that way. What you want to do is you want to go, my property portfolio is strong. This property will make it even stronger, so that the next time I go to buy another property, the bank falls all over themselves, throws money at me. Don't laugh at me. I know it doesn't happen, but you know what I mean. It makes you a stronger borrower, which works better. And also, like, some properties are just harder than others. Sometimes there's just properties you just can't be bothered with. You know what I mean? Great question there by Harvey. To close the retirement gap, I'm close to retirement age. Does the bank discriminate? They will say no, because based on human rights, they're not allowed to. But they do a thing called age and stage. And age and stage is, if you're a first home buyer just moving out of a flat into your first property that you're owning yourself, and you're just about to turn 80, they look at you and go that you probably haven't been as financially good as you could have over the years up until this point, they're going to look at you really, really closely. And that's the way they get around, human rights of not offering somebody a mortgage in their later years. But also, they may offer you a mortgage, but only a 10 or a 15-year mortgage instead of a 25 or a 30, which kind of makes sense when you think about it. But so the answer there, I suppose, is yes or no. Ooh, another good question here. When I see properties going for dollar reserve, I like to work out what that dollar is actually going to cost you. Yeah. I mean, this particular property is monolithic. It's semi-detached. It does leak. It won't go for $1. It'll go for 150, 180,000, something like that. I'll go to the auction this week and film it. I'll let you know. But no, absolutely, totally right. All right. So you'll find a decent property as well. So everybody in the here then should have a really good feeling for that process. And I've probably taught a fair few of you how to just, suck some eggs on that one. So I apologize. But also, you've now got our portfolio spreadsheet and you know exactly where you currently are. And you know how much debt you've got, how much equity you've got, how much cash flow you've got coming in, and how much expenses you've got coming out. So from that portfolio spreadsheet, you should be able to have a pretty good look at that and go, you should be able to really figure out what it is that your portfolio needs next. Does it need equity? Does it need cash flow? Does it need just to have some gain over a couple of years and be left alone? So really the next thing you want to ask is, what's your ability or your lending capability? Can you actually borrow some more money? So this requires you filling in a statement of financial position, which means assets, liabilities, which is mostly what that spreadsheet you've already done last week. If you did your homework, I'm watching you, should come out and tell you. So what we're going to do tonight is bang this out to you. There's a free download. It's a capacity discussion tool. So it's a quick spreadsheet, which will basically, you put in all of the numbers that you've already got on the first spreadsheet we did last week. You fill it in all the right places. And this will give you a bit of a look down of your income, which we just discussed previously, obviously, and your expenses and costs and what it costs you to run your house and your household and your family. And if you fill in all the details right, it should give you a fairly decent idea at the end of this as to what you could borrow if you wanted to go to a bank and borrow some money. I see in the comments there that Sal missed last week's session. So I'll just ask Rome, there's the last week's session's actually on YouTube, and we'll put the link in the comments there, and you can just click on that and pull it up, save it, watch it for later on, because how good are we? It's also on the Facebook page too. I listed it on there too. The free download, the capacity discussion tool, should give you an idea, more or less, whether if going to a bank or a broker, they're going to give you a loan and how much that loan should be, how much you could borrow against your existing assets. Make sense? So once again, pretty blooming useful stuff. The next thing you probably want to do is, and this is some wisdom from my good old friend Sean Wood from way, way back in the day, who said that it's not actually terribly hard to get very wealthy in New Zealand. It's very hard to stay wealthy for a lifetime because things happen. Things come at you from offside. So what Gilligan Rowe do is they are entities and structures experts. So what we're talking here is trusts, companies, because I don't want my assets under my name as Stephen Goody, because I could get attacked by, debt or divorced or this or that or the other. I want to protect my assets as very best I can. And I need to protect them from things that I have no idea are going to come at me in the oncoming years. And I have to do it early and I have to do it well. So what I do is I go to Gilligan Rowe and Associates, and they set up taxable structures and entities and trusts for me to protect my assets that I'm going to build up and that have been building up for the last 30 years. Now, Gilligan Rowe have allowed me, because I'm doing this series with you guys, a certain number of free discussions, like strategy meetings with them. And all you have to do is go to stevegoody.com/GRA, which the awesome Rome has just put into the comments as well. You love this. All these links turn up as soon as I mention it. So easy. So if you wish to have a free strategy meeting with Gilligan Rowan Associates, they usually do them via a Zoom call, like similar to this, really. And they will give you an idea of what they think that you need if you want to make your portfolio bigger, invest in property, trade in property, hold shares, hold any other valuable asset in your name, and are very, very good and very useful at doing that. Excellent. So what we've got there now is the YouTube recording from last week. If you missed that, we will send you the download for the capacity report. And we've given you the link there for Gilligan Rowan Associates for the initial consultation. I think that's nearly enough homework for one day. So I'm happy to answer any questions you like. Once again, nailing it in under half an hour, getting some decent information out there without taking up everybody's evening. And remember that next week, same time, Wednesday, 6:30, we're going to have the final series, which is what should you buy? How many of them do you need to buy? And they're going to make a very, very special offer at the end of that one, which might involve, me giving you some further assistance in progressing your property investment, because I think everybody needs a good kick this year. It's been so quiet in the property market. There's so many properties for sale. Interest rates keep going down and down and down, and we should be all over it. I just want to create some excitement and get everybody pumping and moving along. All right, so any other questions in here, or we will call it a night? Oh, right. Where do I get your insurance, Steve? Mine's 5 times your example. Yeah, insurance does suck at the moment. Mine's gone up about 40% this year, I think. Yeah. At least my Auckland rates didn't go down. My GV, they went up. Who knew? Right. So we've got the GRA link there in the comments, which has just been chucked in there by Rome. So just need to click on that, help you way through that. We've also got, obviously, the recording from the YouTube recording from last week's session sitting there. So that's all good to go.